Welcome to another episode of Millennial Investing Explained. Here's today's question. For those who might be new to options trading, can you explain where the odds or probabilities come from?
Yeah, so in options trading, it's much different than a stock because in a regular stock trade, everything that is known obviously about the stock or is expected about the stock is priced in. And there's only one choice with a stock trade. You either buy the stock at the current price or you sell the stock at the current price. There's no future movement. You can't buy the stock prematurely at a future price and someday. Everything's done on a basically like a cash basis right now. With options contracts entertain two additional elements that make it more confusing and a little bit more complex to calculate, though it can be done. The two additional elements are time. So option contracts can have various timelines, no different than when you buy insurance for your car or your house. You can write a policy or buy an insurance policy for 6 months or a year or 2 years. You can buy life insurance policies that are 20-year terms or 10-year terms. So the longer that you buy protection, the more expensive generally the contracts become. And that's because they're capturing a longer time period. The second element that introduces a little bit of complexity into option pricing is the idea of strike prices. So strike prices, like we already talked about in our example, can be wildly different than what the stock is actually trading at right now. So if a stock is trading at $100, you could strike a deal, and that's why I usually refer to the strike prices. You're striking a deal with the other party at a price point that is much higher than where the stock is trading now or much lower than where the stock is trading now. So now that we have these two additional elements that are kind of baked into option pricing, we now have some sort of time factor. So how far out is the contract until it expires? And then we have a strike price, which is how high or low, how much higher or below the stock price is the strike price of the option contract, like where it actually kicks in and starts to make money or lose money or whatever. Now that we have these two elements, what we need to bring them all together is some sort of expectation of how volatile the stock is going to be. And so this is really where the probabilities are derived from. And they're derived from market participants, actually. So when people always ask, who comes up with volatility? Well, volatility is a function of market participants. So the more active people buy or sell contracts or more actively bid up the price of a contract or not, determines how likely they expect the stock to move in the future. And I always tell people a good analogy of this is let's say you're buying a piece of property and you think that there's gold beneath that property. You don't know for sure, but you think that there's gold beneath that house. So you're probably more willing to pay for that house, maybe even above and beyond its asking price, because you're so confident that there's something beneath the surface, right? Now you don't know for sure, but you expect something. And that's a case of high volatility because either you're going to be really, really right or you're going to be really, really wrong. We actually see this a lot heading into an earnings event where stock volatility will start to go up. People expect a big move because there's an earnings event coming up and they don't know which direction the stock's going to move, but they expect it to move in either a big upward move or a big downward move to reprice it after earnings. So that's where this volatility kind of factor comes in. And once we figure out how much people think the stock is going to move, we can just simply apply simple statistics and probabilities to say, look, there's a 70% chance that the stock gets to this level based on what people think right now, or an 80% chance that it gets to this level based on what people, think and how they're trading right now. So it's a tricky subject for sure, but it's not overly complicated that it couldn't be understood. But that's where it comes from. It comes from option pricing.
And you have to trade enough times to let that probability play out, because just trading one time, two times, you might get lucky or you might get unlucky, but you have to really trade over a significant number of times in order to let those probabilities play out to their true potential. And actually, if you have a 70% chance of being right, the price staying above a certain amount and that being a 70% chance, you actually have to trade that option enough times to let that actually take place, correct?
Yeah, I think it's one of the things that absolutely fascinates me about just human psychology and behavior as an investor is this idea that a future expectation and future probability will play out after 10 occurrences. And I always challenge people on this. If I was flipping a coin with you, so me and you are flipping a coin, and I tell you that this is a fair coin, it's 50% heads, 50% tails, you would agree with me, right? You'd say, yeah, that's a fair heads and tails coin. So I flip the coin 5 times in a row and it lands on 5 heads. Now, what a trader would do in this situation, right? If they were trading a 50% chance of success trade and they lost 5 times in a row, they'd be like, that's it. Markets are rigged. This is a scam. You're a scam. This whole thing is a scam. I knew it. I knew this stuff was totally bogus. You cannot even judge anything until you've had a couple hundred trades under your belt. Really, realistically, 10 trades isn't going to do it. 50, not 100, You might get lucky. Knowing that going into it should change and shift people's perspective on trading. Like if you know you've got to get to say 500 trades, well, now it becomes a game of like surviving, like making sure that somewhere randomly in that string of 500 trades, you don't let something knock you out. Like don't over allocate, don't be one directional. I need to get to 500 trades, to let this thing really work out.
Yeah, and that goes back to having realistic expectations, which is something that I always like to talk about because I think if you go into investing, whether it be options or stocks or anything really in the markets, if you have unrealistic expectations, that plays into human psychology and that leads to bad investment decisions. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.